All the financial markets are plummeting today. I thought that they would recover by last week because last week was crazy, but today's even worse. So here's what I'm going to be doing with my investing and how I'm taking this information. The NASDAQ sinks 4% and Dow cascades down as global sell-off intensifies. Wall Street's stock sell-off kept going in a major way Monday as concerns mounted over the health of the US economy. The S&P 500 is down big today, but not just today. Over the last 5 days, it's down almost 6%. QQQ, the growth ETF, is down over 6.5%, and SCHD is down 4.2%. This is definitely bad, but like I've talked about on this channel, having these broad style ETFs mitigates a bit of risk compared to having a sector or specialized type sector. Everyone's been going crazy and loving these semiconductor style ETFs, and they've been going up like crazy, but those ones that can go up can definitely go down. And the super semiconductor ETF, SMH, is down even bigger. SMH is down over 12% in the past 5 days. It's important to take all of this in with some perspective, but also to use this time as a learning point for your portfolio to figure out how you want to do this in the future, because everything can't just be rosy and sunshine. Sometimes we have bad days or bad weeks or even bad months, and we need to prepare. Everyone went nuts when they learned that Warren Buffett has been selling his Apple shares and thought that meant Apple is dying and that we should sell Apple as well. Or maybe even tech in general is dead. But no, he was just being a smart, intelligent investor like he always has been, and he was making sure to de-risk his portfolio. Look at his portfolio in the Q1 of 2024. It was heavily Apple. Buffett knew that he needed to do what I talk about here on this channel and de-risk the portfolio a bit too, so he's been selling shares to get in more into balance. Looking at his whole portfolio here, you can see why. Now overall, the global stock market is dropping like crazy and has been dropping for a little bit of time here. And I want to remind you that this type of sell-off happens quite often actually, and emotions definitely drop like crazy. That's why Buffett says you must be fearful while others are greedy and greedy while others are fearful. While others are very fearful right now, so I'm loading up on some certain ETFs, but specifically in a specific way. Wall Street's fear gauge, the CBOE volatility index, soared, reaching its highest level since the early days of COVID-19 pandemic. Treasury yields plummeted, with the benchmark 10-year Treasury yield sinking below 3.8%. There's fear everywhere, not just in the United States, and since there's a global sell-off happening, it's compounding emotions. Many people are selling off their positions today in the United States because they've heard what's been happening over the rest of the world over the last couple of hours. And a lot of this comes from the announcement that Powell said last week, showing that the economy is a little bit weaker and that there is a possibility that we hit a recession or at least a slowdown in the near future. The global stock market is in the midst of a rapidly intensifying sell-off after Friday's lackluster US jobs report added to concerns about the economy and on whether the Federal Reserve had waited too long to begin cutting interest rates. Of note, almost 100% of bets are on the central bank to cut rates by 0.5% by its September meeting. Some of the biggest companies in the stock market saw their values plummet at the open today. Apple declined more than 9% amid the sell-off, and also after news that Berkshire Hathaway had cut its stake in the company in half. Nvidia's pullback continued as it dropped as much as 13%, and Tesla plunged more than 6%. Crypto also took a beating, with Bitcoin sinking roughly 15%. In commodities, meanwhile, oil was near its lows of the year, with WTI crude futures down to near $72 a barrel. The US market is headed into a quieter week of data and earnings, with the job market still in focus. Weekly unemployment claims due Thursday will take a bigger spotlight than usual. All of this is not the best news, but we do need to zoom out a little bit. Yes, the S&P 500 is down bad over 5 days, but overall for the year, it's still up almost 10%. It's still close to 5,200, and back in February when it hit over 5,000 for the first time, people went nuts. Look at this chart here, as this is how I look at things. Yes, it's important to know what's going on now, but it's also important to zoom out to the full year, and then very important for those of us trying to build actual long-term wealth to stay the course and look at the very long term. Look at this little dip we're all freaking out about, and then look at all the dips in the past 5 years that look similar, and we came roaring back. I know I wish I could have bought each one of these dips, and I can't go back and do that, but I can buy this one, and I am, big time. Of my 3-fund portfolio, I don't know which one of the 3 is gonna be the one that's gonna take off like crazy over the next 10 years. We could see growth slow down a little bit and value start to rise because that's actually happened in the past. We could just see the S&P 500 just take over. Who knows, but I know that for sure one of them is gonna go crazy, and so I'm gonna make sure and invest in all of them equally. So right now I'm just putting an even 33% into each one of those, just stacking those assets up, especially as they're on sale today, because I know for a fact that all 3 of them are solid funds and that long term they're all gonna be great. I just don't know which one's gonna be the absolute best. And anyone who tells you that they know what the absolute best stock or ETF is gonna be over the next year or 5 years, just be very skeptical. What are you planning to invest in right now? Comment that down below. From CBS News, US stocks plunged for a 3rd consecutive trading day, with the Dow Jones Industrial Average shedding more than 1,200 points amidst growing fears of an economic downturn sparked by a sharp slowdown in hiring and weakening consumer spending. Stocks began losing ground on Thursday after weak reports on manufacturing and construction, which stoked fears the US economy may finally be buckling under the pressure of high interest rates. Then on Friday, government data showed that hiring last month was far weaker than expected, adding to Wall Street's fears that the economy's so-called soft landing, in which the US economy could avoid a recession despite the highest interest rates in 23 years, could instead become a hard landing. The main factor that is staying power is the economy's slowdown, wrote Wells Fargo's head of global investment strategy, Paul Christopher, in a Monday research note. Investors have been watching household financial stress build for the past 2 years, but during that time, job growth remained above its December 2009 to December 2019 average of 180,000 new jobs per month. The economy's slowdown is going to be a huge buzz term and something that we're going to see on this recession watch over the next couple weeks, so be very careful every time that you look at the news or anything like that. That's going to spark a bunch of emotion. As you can see, it's going to keep the market down possibly, but I really think that in September, if they really do cut that rate down 0.5%, that's going to spark a lot of positive emotion. And I believe that the stock market's going to rise sharply because of that. This will give a lot of people and a lot of companies a lot of hope, making it seem like the worst is behind us as far as market rates, and it's going to spark this new idea of a hopeful bull market that's to come and growth that's on the horizon. Watch this video to keep you going strong in your investing, or watch this one and let me know what you think.